In this episode, we're going to talk about what to discuss when prospect buyers are interested. First and foremost, you may get a phone call from someone and they may call, ask if you are the person that you are, and you'll say yes. And they'll say, well, I got your phone number, and they may not give you much details. So you want to assume that they're calling about real estate, right? So you ask them, well, are you calling because you're interested in purchasing a home or selling your home? And they'll say, oh, yeah, that's the reason why I'm calling. Okay, well, how did you get my information? Oh, well, X person gave me your phone number and you helped them to purchase or to sell their home. Okay, excellent. Well, I'm so glad that you're on the phone here with me. So tell me a little bit about what is your goal, and let them talk. Let them explain to you what they have in mind. They may tell you that they want to buy and sell, or they may just tell you that they're first time buyers. So you get an idea of what it is that their objective is. Okay. If they're looking to buy, which is what we're focusing on today, then you want to find out if they're looking to buy with cash or if they're looking to a loan. Most people need a loan, but if they're looking to buy with cash, then you want to make sure that you communicate with them the importance of getting you their proof of funds letter. The proof of funds letter, it's just proof of funds. I'm so sorry. Proof of funds. Proof of funds could be in the form of a letter, but in most cases, it is a bank statement showing that they have enough funds to be able to complete that purchase. Okay. You want to have that before you even show them any properties, because you don't want to waste time with people that say they're going to buy cash and you don't have the evidence to show to see yourself or to show the seller or their agent that this is a ready and able purchaser of that property. So that's really important. If they're looking to purchase with a loan, then you want to ask some questions because you want to get an idea if they have been saving for their down payment and saving for their closing costs. Now, a lot of times they may not know how much money they need to save, and they'll explain that. They'll say, well, I'm not even sure how much money I need. Right? So you may ask them, well, what area of town are you looking to buy in? So you have somewhat of an idea about how much the prices are going for in that area. And you can just like get a number, just grab a number from out the air. You can use a number like, I don't know, 300,000. Say 300,000 is the amount, and that's what you explain to this prospect buyer. Say that you're looking to buy a house that's $300,000. Okay. And, there's different types of loans, right? And later on, we'll have some videos talking about the different types of loans. If you're a first-time buyer buying with a conventional loan, you might be able to qualify to put down as low as 3%. If you're getting an FHA, you may be able to qualify for as low as 3.5%. If you're not a first-time buyer and you're getting a conventional loan, it can be from 5% higher that you put down. Okay? If you're getting a VA loan because you're a veteran, you can put 0% down. If you're getting a USDA loan, 0% down. So it really depends on your personal situation, that buyer's personal situation, as to how much the down payment's going to be. But let's say it's 3% that's being put down on a house that's $300,000, then that would be $9,000. And let's suppose that the closing costs were another 3%, that's another $9,000. You add those two numbers together, 9,000 plus 9,000, you get $18,000, right? But then you want to also calculate what other expenses they're going to have. Most times when you're getting a loan, if you're getting a loan, the bank is going to require that you get an appraisal done. Let's just estimate that that's about $650. Now, an inspection, that is definitely optional, but it's highly recommended. And I say it to the clients just like that. I let them know they have the option of getting it or not getting it. But if they end up not getting it, make sure you get something in writing that says that they understand that they have the right to an inspection, but they have chosen not to get an inspection. Okay, that's to protect yourself. Okay, so back to the amount of money they need in order to close this transaction. This is just an estimation. So we had 9,000 plus, we're estimating 650 for an appraisal and estimating about 550 for an inspection. When you add all these numbers together, you get $19,200. So you want to ask that person, are they in position to cover that amount of money and be able to close? I know you may be looking on the screen and you see that over here it said 550 for the appraisal. Appraisals have gone up some, but also they've gone up some because sometimes they're doing like rushes on it. So that's why we calculated 650 instead of the 550 that you see on the screen. Okay. And also the price of the inspection may be higher. So it's better to calculate a little bit higher than to underestimate, right? Okay. So they say to you, yes, yes, you do have enough to cover that. Okay. If they don't, you can ask them. So you don't have to cover that. Do you have somebody that may help maybe with a gift, so that you can be able to accomplish this goal? And sometimes, many times with our clients, it has happened that maybe a family member's willing to help them with covering that difference, which is allowed. All right, so then we're done with that section. Now, as far as the pre-approval, if they are pre-approved with a loan officer that you're not familiar with, you don't want to just grab that pre-approval letter and just start shopping with them. You want to talk to that loan officer and find out how in depth they have gone to find out if they truly qualify to purchase a home. Because the last thing you want is to have a buyer that you've helped them to get under contract. You've driven them all over town. You've helped negotiate to get them under contract. You're under contract, and that transaction ends up failing because there's something not right with their finances, or there's something not right with the way the taxes were done. Maybe they filed the previous year less income than the year prior, and that's a problem. Okay, the loan officer needs to be able to check all of these things before they give you the letter and have you go out. So whenever you're meeting with new loan officers that you're considering to work with, you need to ask them questions. You want to ask them, hey, so is this person pre-qualified? Pre-qualified means they just talked on the phone. They may not have looked at their tax returns, may not have verified their income, looked at a pay stub, things like that. So they're like just basing it on that person's word. A pre-approval, they've received that information, double checked it, checked to make sure that they would, the bank is likely to give them a approval on the loan. So that's why it's called a pre-approval. Now there's something called a TBD, which is basically almost like if they were like what they do once the buyer is already under contract. When they gather the rest of the documents, submit it to the underwriters, and the underwriters come out with conditions, okay? So when that is before they even start shopping, they call that a TBD. The TBD is almost like the property is to be determined, okay? And things that are left to be done could be something like an appraisal, okay? It's pending approval because they want to make sure that the property that's selected appraises at the value that it's under contract, that you guys have gotten that property under contract for. Okay, so this is important to interview that loan officer to see how far into the process that person is in. That information is also going to help you in the time whenever you are negotiating for your buyer. Because if you are negotiating with your buyer, you're able to put less days of financing contingency days, okay? The financing contingency days or financing contingency period is the amount of time that you and your buyers are asking the sellers to give the loan officer to get a conditional loan approval for this buyer, okay? Back before COVID, a lot of the loan officers were asking for 18 to 21 days, sometimes even more than that. And since COVID came around and there was so much demand for houses, these these real estate agents needed some ammunition to win offers. So a lot of the loan officers got smart and they said, you know what can we do to expedite the process so that these agents are not tying up those houses for so long, those 18 to 21 or more days. So now by doing the TBD, a lot of these offers can be submitted asking for like little or no days. I mean, there's some mortgage companies or loan officers that are able to request and say, okay, we can do this. Ask for 8 days financing contingency days or period. And within that time period, they can make sure that everything's in order so that we can move forward in the process, or you can move forward in the process, which looks very attractive to the seller because the seller is like, 8 days, this other person's asking for 21 or 18 days. 5 days or 8 days looks very attractive to the seller. Okay. So that sometimes can help you whenever you're preparing offers, but you need to make sure that that loan officer can work that fast. Okay. So that means that when you are interviewing loan officers to work with, you want to find out how fast they work. How many days of financing contingency days? What's the minimum number of days they can make this happen in? Also, the financing contingency period. Okay. And in that financing contingency period, you want to make sure that everything that is required for the bank to approve that loan gets done within those days. Okay. Because if something happens within that time period that causes the loan to get declined, then there's a possibility that the buyer could recover their earnest money or could not recover that earnest money. Okay. So if, for instance, the buyer goes and buys a Ferrari to match the fancy house that they're about to purchase, okay, and that's the reason the loan gets declined, guess what? That buyer's not going to be able to recover their earnest money. Now, let's say that buyer is in a situation where they lose their job or something of the sort within that time period, then yes, it's very likely they'll be able to recover their earnest money. Okay. There's things that are sort of out of the ordinary. Like, for instance, maybe the HOA is having issues because not everybody's paying their dues. And this may happen like in a condo community, okay, where not everybody's paying their dues. And the mortgage company usually needs to get this questionnaire from the HOA. And if that questionnaire comes in and it's looking like, you know what, it's making the mortgage company feel uneasy about giving the loan, and it ends up getting declined. If it gets declined because of that reason within that financing contingency period, then you can work on saving that buyer's earnest money. But if it happens after that period, then it's very likely they're going to lose that earnest money. So it's really important for you to be on top of that, okay, and be aware of that. And if you need to get an extension, then you do an amendment to get and ask for that extension. So explaining the reason for it. Okay. So that's something that's important for you to understand, why it's important to be working with someone, a loan officer that you have good communication with, because things do come up. Okay. So again, if they come to you saying, I am already pre-approved with a lender, whatever, make sure that you make communication, or you communicate with that loan officer to find out how far in the process they're in and how strong of a buyer they are, so that you know how to sell your client to the seller of the house, okay? So that the seller is more likely to consider working with your client as opposed to someone else's client, okay? Whenever a loan is pre-approved, it means that the loan officer has already checked their credit, check their assets, how much money they have, if they have 401k, if they're going to be using that, so on and so forth, whether what their balance is in the bank, whether they have enough money to put the down payment and the closing costs, etc. They verified the income with pay stubs and things like that. Okay. So that's really important to be done. If they're open to working with your preferred lender, then you want to make sure that you give them at least 2 or 3 options of loan officers to work with. Okay. Because you want to make sure you cover yourself. Okay. Because things do happen. And if something goes south, you want to make sure that you can have evidence that you gave him options and they had the opportunity to interview each one of these. And they went ahead and went with option B of the 3 that you gave them. Okay. So that was important for me to mention to you. Okay. So that's a conversation that I like to have with the potential buyer to make sure that we know where we're going to be working, whether we're going to be working with the loan officer that they're currently working with, or if they want to consider working with one of our preferred lenders, and the reasons, why it would be of benefit to them. Now, if they are needing to get pre-approved by one of our preferred lenders. Now, before I go and send them to the loan officer, I do want to have somewhat of an idea of how they stand. And I usually ask them if they have any idea of what their credit score looks like. Now, if it's somewhere around 620 or so, looks good, okay? If it's below that, then, you might ask some questions, or you might even ask the client if they say that, I think my credit score is bad. You might want to ask them, well, what do you think is bad? A lot of times I've heard, whenever I've asked that question, I've heard them say, well, I think mine's bad because I've never bought anything on credit. Well, if they've never bought anything on credit, never bought a refrigerator, any appliances, a car, anything like that, they may not have bad credit. They may not have credit. Okay. And that's something that's workable. That's something that can be developed. Sometimes it's a matter of just, that person getting added to someone's credit card as an authorized user. Now, I'm not telling you to go and tell them that, but that's something that is doable and that could happen in a quick manner. But that's where you say, you know what? This is what I would advise you to do. Since you think you may not have any credit at all, I think it would be really good for you to talk to one of our preferred lenders. If that's okay with you, I can help facilitate that process. Here's the list of 3 of our 3 preferred lenders, okay? And then maybe send a note to each of the preferred lenders and let them know, hey, I have somebody that may be reaching out to you. And I ask him if it's okay if they contact them, and I make that happen, make that connection. So that way, and I let them know that if they want to, they want to talk to them, or my recommendation is to compare notes, see what option A is bringing to the table, see what option B is bringing to the table, and then ask them to provide a loan estimate so that they can be able to somewhat compare apples to apples and be able to see which option is best. Now, whenever they're looking at that loan estimate, they can at least get an idea of what they're estimating the interest rate could potentially be for them in their situation. And it can also give them an idea of how much their loan origination costs are going to be, how much is it going to cost, how much they're estimating their closing costs may be, okay, if they do their loan with that mortgage company. Okay, so with that said, I think we're going to stop at this point. And then we will resume the next one about a different topic. All right, I hope that this is helpful. And remember that this is important. This is really valid information. Make sure that you use this as a resource and you come back to this periodically whenever you need a refresher. Okay, so remember, we are always here to help our clients with the sale of their house and the purchase of their next home. And you are an important factor in making that possible. All right, I'll see you next time.